Everyone keeps asking, why did silver just crash 33%? But they're asking the wrong question. The real question is, who got the margin call first, and what were they forced to dump in minutes, just to stay alive? Because by Friday morning, the stage was already set for a massacre. Margin debt had just printed at a record $1.225 trillion. That is a global powder keg of borrowed money. And then, one headline hit the wire. Donald Trump picked Kevin Warsh as the next Fed chair. Now think about what that means when leverage is this high. The first wobble doesn't create fear, it creates forced selling. And as of this Saturday, January 31st, spot silver is fighting to hold near $85 an ounce, after printing a terrifying low near 77.72 on Friday. Spot gold is still swinging around the 5,000 handle, but only after dipping under 4,900 intraday. So no, the damage wasn't just metals. The Nasdaq finished Friday in the red, and it was led by a massive 11% collapse in Microsoft. 11% in Microsoft! And the giants of the mining world got smoked too. Newmont dropped about 11.5%, Barrick slid roughly 12%, and Agnico Eagle fell nearly 11%. So if you're watching this like a normal risk-off day, you're going to miss the real mechanism. Because right as the market was bleeding, the CME clearinghouse pulled the trigger. They just raised margin on Comex gold futures to 8% and on Comex silver to 15%. And here's the part that matters. This is the deadline. And these rules go into effect after Monday's close. So let me give you the contradiction. Clean and simple, gold and silver were pitched as the safe trade. Yet on Friday, they moved like the most crowded, most leveraged trade on the board. How does that happen? It only makes sense when the villain isn't fear, it's margin. Because in a margin call event, the market doesn't ask what's safe. It asks what's liquid, what's fast, and what can be sold right now, without breaking the order book. And that's why the right question was never, why did silver crash? The right question is, who got the call first, and what did they have to dump to survive? Because Friday wasn't a normal sell-off. It was a margin call event. And in a margin call event, the market doesn't ask what's safe. It asks what's liquid, what's fast, and what can be sold right now without breaking the order book. So this is a timeline, a chain reaction, where the first domino wasn't even in metals. And once the chain starts, there's a brutal rule. The assets that held up the best become the assets that get dumped first. Not because anyone hates them, because they're the only ones with profit left to harvest. By the end, the question won't be, why did silver fail? It'll be, who was forced to sell, and who had the cash when forced selling hit? Now before the timeline, there's one number that explains why this month was wired for a blow-up. FINRA's latest margin statistics show customer debit balances in securities margin accounts at about $1,225 billion for December. That's the powder keg. Margin debt is borrowed money used to hold positions. It's a crowd standing on a balcony, all leaning the same way. It looks stable until the building shakes. Then everybody tries to move back at once. And the shake didn't start in silver. It started with a name, Kevin Warsh. On Friday, news broke that Donald Trump intends to nominate Warsh as the next Fed chair. The market immediately pivoted to a hawkish mindset, betting on a stronger dollar and higher rates. This was the spark that hit the setup. Earlier this week, gold had smashed through record territory near 5,600, while silver touched a parabolic peak of $120.45. It was a massive one-way bet funded with record leverage. Then the Warsh news hit, the dollar surged, and the tech complex, led by a massive 11% sell-off in Microsoft, finally slipped enough to wake up the risk managers. Here's where the margin call logic kicks in. Big funds don't run one isolated position. They run a book. Tech, AI, metals, rates, credit. And those positions share one heartbeat, collateral. When the Nasdaq drops, it doesn't just hurt profit and loss, it hits risk limits. It hits VAR, value at risk, basically the speed limit on how much a portfolio is allowed to swing. And it hits margin requirements at prime brokers. So the call goes out: post more collateral, reduce exposure. Do it now. And when a fund needs cash fast, it sells what it can, not what it wants. That's why safe havens can crash with risk assets. Not because the world suddenly trusts everything, because the world suddenly needs cash. Now let's run the timeline like a flight recorder. Thursday was the peak. Gold printed above 5,590. Silver printed above 121. Breakout charts went viral. The trade felt unstoppable. Friday was the air pocket, made worse by an exclusive Reuters report claiming the US might pull support for strategic metal price floors. Our algorithms didn't wait for a fact check. They triggered millions in sell orders in seconds. At one point, spot silver was down 28%, hitting a low near 77.72. That's not a pullback. That's a forced, algorithmic unwind. Gold did the same, just with a calmer face. Spot gold fell toward 4,890 and traded down roughly 9 to 10% at points. That made it the steepest one-day slide in more than 4 decades. So what changed in 48 hours? 2 things. The collateral math changed, and the exchanges tightened the screws right as the market was already slipping. This is where the margin call narrative becomes the cleanest explanation. Picture a fund that rode the AI rally and the metals rally at the same time. Tech starts sliding. As the fund's equity cushion shrinks, the prime broker wants more cash. The fastest way to raise cash is to sell the position that still has buyers and still has profit. Gold and silver were that position. So, metals get sold, not because the fund flipped bearish, but because metals were the ATM. And once the first big seller hits the bid, volatility explodes. When volatility explodes, margin models update. This month's shift to percentage-based margins is the quiet accelerant. In the old system, a fixed dollar margin could lag volatility. In a percentage system, the exchange can reprice risk in real time. So when the tape turns chaotic, the percentage can rise, even while the price is already falling. It's like an elevator with a moving floor. The trader thinks the account is barely above water, then the floor drops. And suddenly the account is underwater without taking another trade. That's why this episode looks technical on the chart. But it's really mechanical. It's the collateral engine changing gear. Then came the hammer. A CME clearing advisory dated Friday, January 30th, set new span minimum performance bond requirements, effective after the close of business on Monday, February 2nd. For standard risk profiles, Comex gold moved to 8% from 6%. Comex silver moved to 15% from 11%. That silver jump is roughly a 1/3 increase in required cash, and this is the part most people miss. An exchange margin hike doesn't warn traders, it forces them. Here's what 15% margin means in plain English. A standard Comex silver contract controls 5,000 ounces. At about $85 an ounce, that's roughly $425,000 of silver. At 11%, the minimum collateral is about $46,750. At 15%, it becomes about $63,750. That's roughly $17,000 of extra cash per contract, on top of losses already taken in the drop. Gold is similar. A standard gold contract controls 100 ounces. At about $4,900, that's roughly $490,000 of gold. Moving margin from 6% to 8% raises the minimum deposit from roughly $29,400 to roughly $39,200. And futures have 2 lines of defense: initial and maintenance. Initial is what's needed to open the trade. Maintenance is what's needed to keep it open. When volatility spikes, those lines move up. And anyone below the line gets a forced reduction. That's why margin hikes feel like a fire drill. Not everyone is wrong. Some people just don't have the spare cash sitting around at the exact moment the rules tighten. If a trader can't add collateral, the broker reduces the position. And reduce usually means liquidate. That's why margin hikes often land right on the bruise. They don't cause the first crack. They widen it. Now layer in the other institutional lever that hit this week. The China lever. Shanghai's metals complex had already been tightening. Shanghai Futures Exchange announced adjustments to margin ratios and price limits for some silver futures contracts. So by Friday, silver wasn't just a global chart. It was a global risk management problem. China tightened, then CME tightened. And in between, tech wobbled enough to trigger cross-asset deleveraging. That's the timeline. It's not one villain. It's stacked pressure in the same direction at the same time. And stacked pressure changes market behavior. In a normal sell-off, liquidity providers step in. In a margin call sell-off, they step back. And they widen spreads. They wait for the forced selling to finish. That's why the move feels like it happens in minutes. Stops get triggered. Then the stop cascade becomes the story, and silver is built to cascade. Silver has a smaller market than gold. It carries higher day-to-day volatility. And in derivatives, it attracts concentrated positioning when retail gets involved. So when leverage unwinds, silver tends to overshoot. That's how a record at 121 can turn into an intraday print in the high 70s, almost before the crowd realizes the direction changed. Now, the viral claim floating around is that trillions evaporated in minutes. However anyone counts it, the important part is simpler. Leverage makes a price move behave like a demolition charge, because the market isn't just repricing metal, it's repricing collateral. And collateral repricing hits everything connected to the trade. That's why the victims list lines up exactly with the leverage story. Mining stocks got smoked. Newmont fell double digits. Barrick fell double digits. Agnico Eagle fell double digits. Not because their mines changed overnight, but because they're the equity expression of the same trade. And equities get hit hard when risk managers delever. In India, the Nifty Metal Index fell around 5%. Names like Nalco and Vedanta dropped around 7 to 8%. That's the spillover. Now here's the mid-script cliffhanger, because this is where the story flips from bad day to structural. The margin hike is effective after Monday's close. That means the market has a countdown clock, and countdown clocks change behavior. Some traders cut risk rather than wait. Some brokers raise internal requirements early. Some funds reduce gross exposure across the whole book because they don't want to be forced sellers. So the pressure doesn't have to end with Friday's close, it can echo. Now step back. This is the core lesson of the event. Gold and silver didn't fail. They got used. They were the liquid source of cash to defend other positions. That's why the crash showed up as a mirror image across markets. Tech down, metals down, miners down. That's a delever wave, and it also explains why the move can reverse fast. Once forced sellers finish, the market can bounce. Not because fundamentals changed, because the selling flow stopped. So what matters next isn't the mood, it's the gauges. Gauge 1, the dollar. If the dollar keeps firming, the hard asset bid loses fuel. If it fades again, the metal bid can return quickly. Gauge 2, real rates. If real yields rise, it raises the opportunity cost of holding metal. If they fall, it lowers it. Gauge 3, margins and collateral, across exchanges and prime brokers. When margins rise, leverage shrinks. When leverage shrinks, price starts acting like a normal market again. Gauge 4, positioning and flows. Open interest, ETF flows, and positioning reports will show whether the crowd actually left or just got shaken. And Gauge 5, the miners. Miners are the stress test. If miners can't bounce even when metal stabilizes, it often means the equity side is still de-risking. So the final scorecard looks like this. 1. The rally was leveraged and margin debt was huge. 2. The trigger came from another part of the book, not from silver itself. 3. The sell-off accelerated when institutions raised collateral requirements into an already falling market. 4. The victims were exactly the assets connected to the same trade, from miners to metal indices. 5. The countdown to new margin rules creates the possibility of aftershocks. And that brings it back to the opening contradiction. Gold and silver didn't move like safe havens, because the market wasn't doing fear. It was doing liquidity. In calm times, safe haven logic can work. In deleveraging times, cash is the only haven that matters. But remember, the new CME margin rules don't kick in until Monday's close. That means thousands of traders are spending this weekend hunting for cash they don't have. If they can't find it, the liquidation might not be over. The system just showed its real rulebook, the one written in collateral percentages, not headlines. And once someone sees that rulebook, the Friday crash stops looking counterintuitive. It starts looking like a margin call event that finally found its spark, and then ran the exact script leverage always runs.